Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. Well, what a whipsawing month April was, and as you'll be hearing shortly, a lot happened beneath the surface in the managed futures arena beyond the market's high volatility and headlines. According to Morningstar data, dispersion between the highest and lowest performing managed futures strategies in the category of mutual funds and ETFs was over 16%. For 1 month, that's pretty incredible. So, with that setup, we're calling this month's update the high cost of complexity. And I'll hand it over to you here, Andrew, to color in those lines alongside details on recent performance and attribution. Over to you.
Thank you, Mike. Well, that was exhausting. So I don't need to recount here what an insane month it was. The tariff sledgehammer, followed by a market freakout, followed by a hasty retreat, followed by recovery. So the quite remarkable news that DBMF ended the month flat when the target SocGen CTA index, here and after the hedge fund index, was down 4.5%. This ranks among the best months on a relative basis since inception. Now, the figures all the way on the left are year-to-date returns, and since we were neck and neck with the hedge fund index through March, we now stand around 400 basis points better this year than the hedge fund universe, and a similar amount relative to the Morningstar US Trend Systematic category, here and after the Morningstar category. Now, as a reminder, we were also ahead of the hedge fund index by nearly 500 basis points last year, and hence the past 16 months have been a pretty remarkable period of outperformance for replication. Now, the common thread is that there has been a real cost to complexity. Now, the first cost is that many of the marketing enhancements, short-term models, vol controls, more exotic futures that were supposed to add value have actually hurt rather than helped performance. Now, even worse, they contributed to drawdowns at the worst possible time. The second cost, clearly, is that investors pay more for these bells and whistles. Look, we think it's time for serious allocators to take a hard look at this and stop thinking about whether, managed futures is a replica or replication is a watered down version of CTAs, but rather simply whether it's a more compelling way of getting exposure to the space. Now, the last bullet point is about an epic battle between the signal and the noise. CTAs generate most alpha when they pick up changes in information, like the return of inflation, but can struggle with near-term shifts in sentiment. Now, clearly, the world is going to look quite different going forward, and this should create great opportunities for the space. The challenge, as we've seen recently, is going to be weathering the volatility. Note that during 2015 to 2020, when the noise coming from the US administration was high, replication materially outperformed the hedge fund index. So we don't think the past year or more is by any means a fluke. Next slide. So this slide shows year-to-date performance of DBMF versus the SGCTA, Morningstar category, and Bloomberg US Ag. Now, I'd like to point out two distinct periods to illustrate how and when replication tends to outperform and underperform. First, from mid-February to early March, we underperformed the hedge fund index. Now, this was due to a concentration in the euro, which spiked when Europe decided to rearm. On the flip side, as the chaos was unleashed on Liberation Day, and this reverberated through markets in early April, actual CTAs suffered much more as short-term models and non-core positions were whipsawed. So to reiterate, there is noise in replication relative to the rest of the space, but our belief is that efficiency puts the wind at our backs to outperform over time. Next slide, please. Now, turning to our inception to date performance, it's the same old story. DBMF has outperformed the hedge fund index and by an even wider margin the Morningstar category since launch in 2019. So our drumbeat is that replication is a systematic, repeatable investment process with structural alpha, with alpha based on efficiency and lower fees. Now, alpha is scarce, and we want our clients to get more of it. Now, as noted, please feel free to contact Mike, and he can share with you both a longer-term track record of our live performance and for capital markets assumptions and benchmarking, the index SocGen built using our replication engine, which goes back to 2002. Next slide, please. Here's our slide on volatility-adjusted positioning. We remain long gold and, a recent addition, crude oil. Despite a major de-risking in April, we still have a slight short position in the euro, which is due to give back some gains. We're modestly long the front end of the treasury curve, which should benefit if we hit a recession and rates drop. And lastly, we are long non-US equities and short the US, which could generate gains if this truly is the end of the American exceptionalism trade. Which brings us to the next slide. Here's our contribution by factor. In April, we had a series of small wins, commodities, treasuries, 2 of 3 equity factors, that were offset by losses concentrated in currencies and long EFE positions. And now for year-to-date contribution. On this slide, you can see the long gold position has been the big winner this year, but this is more than offset by losses in the euro. We're still a bit behind year-to-date in treasuries, but slightly ahead in equities. As we've discussed in the past, when big shifts in information occur and flow through markets, we like to see gains in 3 of the 4 asset classes. And with that, I'll pass the baton back to Mike.
Thanks, Andrew. So let's wrap up with long-term performance numbers for DBMF. Annualized return since inception, including the month that was April 2025, is now 6.36%. That's ahead of the SocGen CTA index by 263 basis points annualized, and it's ahead of the Morningstar systematic trend average by 414 basis points. The Ag has had a good year, but long-term outperformance against it by DBMF remains well intact. DBMF outperforming it by over 520 basis points annualized. So thanks as always to our clients, to our prospective clients, for your confidence and your interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.